let's bring in now Oppenheimer, Chief Investment Strategist, John the Karate Kid Stoltzfus. Okay, so John, listen, what I did appreciate when I went through your work was, I hate to say it, but a lot of folks on Wall Street think it's them, not the street. They don't listen to the markets. They don't listen to the data. And it's always the market that's wrong. When I read this, our positive outlook for the S&P 500 is based on a number of factors that include persistent resilience, evidenced by the U.S. economic data, and so forth. Oh, you're looking at the data. You're not trying to, you're letting the data interpret itself.
Like the Fed, we're data dependent, Charles. And it's got to do with economic data as well as revenue and earnings growth and the trends in innovation that drive all 11 sectors.
I think that the resilience part is really, I think, this, and we've talked about this over and over again, the resolve of the market, the resolve of the economy, this massive reversal since those April lows is just, it's hard to ignore, and yet people do, or try to.
Yeah, the thing we find is we like resilience because life isn't easy, and neither are occurrence related to the economy or related to developments within different companies, as we know just in the last few days as the market does some rotation around some changes of opinions. And when you get to that, what we see is an environment where you have to be resilient. Heck with robust. Robust makes you vulnerable, but resilience shows an inner strength, conviction about what you're thinking and your goals and objectives and how you plan to meet them.
And of course, we love it when the market and the stock market reflect that as well.
Yes, sir.
2026 economic drivers. So we've talked a lot on this show about fiscal policy, monetary policy, innovation progress, corporate earnings. I like this term you use. You didn't say the AI trade. You said innovation progress. Yep. What is this suggesting, that AI goes beyond now the picks and shovels phase of this whole thing?
Yeah, we think it goes beyond the picks and shovels. Whenever we talk to people, whether we're speaking with people socially or in meetings that are directed towards institutional investors like ourselves, we come across people, whether it's in industry or whether it's in their consumer life, they're using it to create greater efficiencies, greater access. And they're not depending on it to have the answer, but provide the insight into material that they may not be able to get as quickly on their own.
Let's talk about earnings. Third quarter is done just about. You got a few stragglers out there here, but for the most part, every sector has had 100% reported. Positive and negative sales growth. Again, it's just been absolutely phenomenal. Positive, for the most part, overwhelmingly swamping negative. Earnings growth, more or less the same thing. I guess the question here is, this is an amazing quarter. Superseded all expectations. Can it be sustained?
We think it's likely to be sustained, and we don't mean we might not find some lumpiness in the course of the next 4 quarters. But this said, if you look back, this whole year has been surprises. Fourth quarter, positive surprises, first, second, third. So we think this persists, and it's a result of several things, and it really has to do good Fed monetary policy overall since March of 22, in that it honored its dual mandate without upsetting the apple cart of job growth, and at the same time got inflation down to a band of around 2.8 to 3%.
All right, so let's talk about opportunities right now. Of course, I started out talking about how cyclicals are doing better, value also looking pretty good here. Of course, growth dominated in every sector, whether it was all caps, large caps, small caps. But this year, a lot of people thinking maybe growth, it's in value, time for, not growth, but time for value to shine.
Charles, when we look at it, we've got just last year, first half belonged to value. All of a sudden, it was in their court. Second half, it was all growth. And we think we just have to watch the data and see how it rolls. But it does look, because of fiscal policy, monetary policy, it looks like growth has a really good chance to outperform another year.
Cyclicals, you like cyclical names.
And I've liked them for years. I've been 42 years in the business, 13 years with Oppenheimer. Since I got to Oppenheimer, we have been consistently cyclicals over defensive.
For you, that's overweight?
Outperform.
Outperform here, information technology, consumer discretionary. Industrials?
Yes, industrials, financials. And, we haven't done too badly with that. Sometimes we're tough on our underperforms. I think healthcare did a little bit better this year, did a little bit of a rally. But real estate, this was not its year. And we called that very accurately. But we think next year has a good chance.
Yeah, right now it's underperformed, but that could change, right?
Yes, sir.
Before let's go, let's talk about the Federal Reserve. A lot of chatter again. Every day they're talking, right? So I thought Paulson's comments, Anna Paulson was the best. She's essentially saying that she still thinks policies is somewhat restrictive and it's restrictive enough to continue to cool inflation. Ironically, even though Goolsbee dissented, if you listen to everything he said today, it sounds like he may be ready to cut next year and cut a lot. We still have Hammack, who's really still on the inflation fence. Where do you think with respect to the Fed? You just gave him a nod since 2022.
Yep.
Not everyone agrees with that. What do you expect from them next year?
We think they're going to keep cutting this year, but we think the way we're going to do it, we've got the first from January right through May, right? It's still going to be Powell's.
Right.
He's at the head of the Fed. We don't think there'll be a huge change in transitioning to the next Fed chair, but we do believe that what we'll see is perhaps 3 cuts this year, this next year, in 2006. And probably, though, still in that area of somewhere total of 75 bips to 100 max.
Wow.
Because you got to balance the dual mandate. Sustainable economic growth without untoward levels of inflation, but not upset the apple cart of job growth.
I think the market would be happy with that. I know I would.
Great
Looking
seeing
good,
you.
my man. By the way, you
Hey,
have to get some new suits here real soon.
I think so, sir. I think